have come here to chew bubblegum and kick ass. And I'm all out of bubblegum.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. I hope you liked yesterday's show. I got a lot of responses to it. It's actually a replay of a previous show, and it as I think I probably mentioned in it, it's really one of the main reasons that this show even started. And boy, I tell you, it can be so frustrating. The thing that always gets me is the folks who tend to respond most to that topic, to discussing that, tend to be other real estate agents. And it ends up being either, here's where you've got it wrong type conversation that starts out with, you're totally wrong. Or it's, thank God I have found someone who has been thinking the same thoughts I've been thinking. I love the latter, hate the former. There really is no excuse for the stuff that agents get up to in terms of just the casual, easy lies that they sort of roll into their business on a daily basis. And again, this isn't because these folks are naturally inclined to this. It's how they're trained. So it makes it more difficult for you as a consumer of their services. And I think really underscores how important it is to pick your agent carefully. All right. So, and I appreciate all the folks who've reached out. I've had several agents who reached out who were really excited about the fact that someone was kind of saying it out loud, and that's fine. And I'd love to say it's miraculous, but it's, I've been saying it since forever. Mid 90s. The first time I started saying it in a format that I uploaded to the internet was 2007. So it's been a while. But I'm glad it resonated with so many people. For those of you who it didn't resonate with, for those of you who are agents who still think of it as an innocent way to connect with your clients, find a truthful way to connect with your clients. Find data that isn't completely meaningless to your clients. Find relevant things that your clients should want and need, and represent their best interest. Because when you're doing it based on even things that you don't say out loud that are lies, but you let the implication rest, and you know exactly what the implication is, you just don't contradict it. That's lying too. I hate to break the news to you. It's all about disclosure. It's all about fiduciary responsibility. It's all about agents honestly putting the needs of their clients first. And that includes giving them advice that might just cost you part or all of your commission. Sorry, that just is what it is. And even if you're the most plotting agent out there, you should be able to at least see that if you do give advice that would lead a client to potentially doing something that would not make you as much money as you might, or won't make you money at all, just bear in mind that people notice when you do stuff like that. And the odds of them referring someone to you or coming to you when they do decide they want to do something that ends up making you money are far greater. You're going to be someone who's memorable because everybody else is trying to pull money out of their pocket and you're not. All right, sorry. We already did a show on it. I don't need to recover the ground. Interesting article from Housing Wire today. And this is something I alluded to last week. I think Thursday or Friday we talked about it. The Fed did not raise rates. We didn't think they were going to raise rates here on the show, and they didn't. But they did do something more interesting. Now, we've talked a lot about quantitative easing, right? And the reason why and I know it's not a sexy word, right? It's like talking about, I don't know, brake pads. It's also a bit confusing as to what the heck it is. So the reason why we've used the word quantitative easing is because it's the code word. All right, quantitative easing is the word, the phrase that's been thrown around since before the downturn, primarily it started at the downturn as far as why you should care about it. And what it basically means is printing more money. And when you're printing more money, you're issuing bonds, you're doing all these things that are representative of that newly created money. And we have done it to ridiculously high levels, right? Well, the one thing that the Fed decided that they're going to do is to start uneasing, pulling back on the quantitative easing. In other words, pulling more money in. And that's interesting because it will absolutely impact the world of real estate. Anything that impacts the world of money impacts the world of real estate. And in their September meeting, the Federal Open Markets Committee announced it will begin reducing, and get this number, this is an insane number. It's 4.5 trillion portfolio of bonds purchased during the global financial crisis as soon as October of this year. To translate, that's all the money they printed, right? When they're talking about bringing back, when the Fed is talking about reducing its portfolio of bonds, they're talking about money that they printed. And according to this article, and just rational thought, this could have major consequences for the housing market. 40% of the portfolio is made up of mortgage-backed securities that the Federal Reserve started buying in 2009. Now, mortgage-backed securities, that's another code word, right? The mortgage-backed securities, typically that were in the deepest trouble, were these subprime mortgages that were bundled, like hundreds and thousands of mortgages were bundled together into a security that could then be traded, right? And the Federal Reserve started buying them up because they were going bad. The plan will begin in October, according to what they said, reducing the $4 billion with the reduction of $4 billion per month in mortgage-backed securities. So that was that was a billion with a B, not a trillion with a T. But each month they were printing much more than that, right? But the plan now is to draw down with a reduction of $4 billion per month in order to cut it back. The pace of mortgage-backed security sales would then increase by $4 billion each quarter, up to a maximum of $20 billion per month. During the crisis, the Fed's actions were designed to bring interest rates lower, which they did, lowered homeowners' monthly payments, and encouraged investment in the housing market, according to Mark Fleming, the first American Financial Court chief economist. Now, the quantitative uneasing could have the opposite effect. Quote, for much of the past decade, the Fed has been the largest investor in mortgages in the world. That's a quote from Mike Frattantoni, Mortgage Bankers Association chief economist and senior vice president for research and industry technology. Quote, the Fed took the first step today to begin to shrink their holdings. In other words, to do less monetizing, to do less creation of dollars, which could be a good thing. It would absolutely potentially be a protection against inflation. We've talked about having less money out there is a good thing. The expectation is that private investors will step in to buy mortgage-backed securities again. I'm not sure that's going to be something that happens anytime real soon. He went on to say that the MBA, Mortgage Bankers Association, doesn't expect the balance sheet reduction to have a large impact immediately, as its beginning was very well telegraphed. As the pace of reductions increases through 2018, however, there could be a larger impact on rates and the potential for additional rate volatility. So let's translate that into English. What they're saying is that the interest rate that you pay, now remember, we've talked about what interest rates tend to be tied to, Treasury notes. So a lot of this has to do with how this impacts those. Fannie Mae estimates the uneasing could cause interest rates to eventually move up by 25 to 40 basis points. To translate that into English, that means anywhere from 0.25% to 0.4%. So less than 0.5%. That's a nice gradual change. We're not talking about drastic increases in interest rates. But this is exactly the kind of information you're going to want to know. And it's also good that these are actions that are likely to be taken over a longer period of time, because it might be a good indicator to you that you should consider accelerating potential investments if you're looking to leverage a lot of money and do a lot of financing that relies on a reasonable interest rate for you, or if you just want to get the best rate possible. And remember, historically, we are not at a place where these rates are normal. When I first got into real estate in 1988, I can't even remember what they were at. I know that the worst they got at one point before I was a real estate agent in the 80s or the late 70s was somewhere in the neighborhood of 17%, 18%. And I think when I first got into the business, things were like 13, 14%. And and a few years later, I remember the day that interest rates went below 10%. Because suddenly all these properties that have been sitting on the market forever, I think the market rates went down like on a Thursday or a Friday, and they were finally at like 9.9 or 9.8 something percent. And suddenly all these properties that have been sitting on the market forever just sold like over a weekend. I'd been keeping an eye on a couple of them as potential investments, and I was stunned. I had 3 or 4 different properties. Property values had been going down. Folks had been lowering their prices. I had made offers that were much lower and not gone anywhere. Well, over the course of that weekend, suddenly every buyer in the world thought, this is amazing. We have under 10% interest rates, so we should take advantage of it. And they jumped into the market and purchased up an awful lot of houses. So this may work the other way. This may be a situation where once we hit that point, and remember, we've talked about this before, there is going to be a number that psychologically kicks people in the butt and makes them say, wow, we have finally hit, I'll just randomly pick a number, 5%. Maybe that's it. Maybe that's the number where buyers say, I really need to do something now. If I wait any longer, my ability to purchase will be dramatically impacted negatively. So I better do something before interest rates go back up. The other thing is, given the way folks have tried to manage the markets, it wouldn't surprise me if that ends up being the popular refrain in the media to say, wow, interest rates have just hit 5%. Experts all say we can go back to historically normal interest rates of 8%, 9%, whatever number they'll throw out. And that'll all be designed to really, again, affect the market from the buyer side to get more buyers. At least if we see a continuation of the kind of methods that have been used so far. I've always argued that we need to do something on the supply side, but everything has been aimed at getting buyers to go out and buy. So I think that moving forward, I think over a longer term, a year or 2 years, I think that would be more likely. So where do you go with this in terms of actions? I think you keep a good eye on this. I think you realize that probably over the next 6 to 12 months, we're not going to see dramatic increases in interest rates unless some other big financial thing occurs. But this is absolutely indicating that, and I actually think this is a good thing. I think that the idea of them quantitatively de-easing their situation, I think is actually a good thing. It's potentially a scary thing, but I like the idea that they're doing this. I think it's medicine that needs to be taken, and it's good to see them drawing it down. Because remember, we talked about the number that's floating around out there. We talked about $4.5 trillion in terms of their portfolio of bonds. Normal for them in terms of what they hold, if I recall correctly, is something closer to 600 billion is what would be considered a quote unquote normal number for them to hold. One interesting thing to note is the folks at Capital Economics was discussing this issue. And I think that their point is a good one. They're doing this at such a cautious level. I mean, remember, their expectation is that we're talking pretty much a maximum of 40 basis points, less than 0.5%, influencing for the foreseeable future. The initial pace of the runoff, according to the folks at Capital Economics, will be capped at $10 billion per month, which is trivial relative to the size of the Treasury market and the scale of the Fed's monthly purchases when it was last accumulating assets. And that's absolutely true. I mean, we're talking about trillions of dollars, and trimming it down by $10 billion per month is not going to be a huge hit, I think, for anybody. From the folks at Realtor.com, quote, the Fed's decision today to begin scaling back purchases of mortgage-backed securities in October is likely to lead to an uptick in mortgage rates and may even bring more volatility to the rates, so more fluctuations. I think that's reasonable too. I think that folks might be more sensitive to other things. And remember, the psychological effect we talked about. Whenever uncertainty gets plugged into the marketplace, all the times, and we've called it on here on this show every single time. Every time they've raised interest rates at the Fed level, I have told you, do not get your loan locked in a week to 2 weeks after that happens, because interest rates go up based on psychological stuff, and then they come back down based on reality stuff, the things that actually tend to influence that number. In fact, every single time this has happened where they reduced or they increased the rate, the prime rate, we ended up seeing rates being lower than they were before the increase within, a month? So that might change that equation. The overall uncertainty might be enhanced and have a longer, more lasting effect given this. But again, at $10 billion per month, I don't think we're seeing a big enough change for folks to really get freaked out by that. Now, the other feedback we got from the National Association of Realtors, Chief Economist Lawrence Yun predicted mortgage interest rates would climb slowly upward, hitting 4% by the end of this year and 4.7% by the end of 2018. I do not think that will happen. I do not think we will see 4.7. We may see low fours, 4.2, 4.3. I don't think we'll get up as high as 4.7. Again, unless something else happens. So keep that in mind. One other little tidbit that I wanted to share with you that I thought was kind of interesting. There are still 2.8 million homes still in negative equity at the end of the second quarter of 2017. If we're right, and we are seeing a situation where we're sort of reaching the top, where we're sort of peaking. And there's an awful lot of news out there. I mean, some of the headlines, if you are browsing the headlines like I am, let's see, housing starts are down. Have we hit the peak? That's been some of the latest news over the last week or so. And CoreLogic is reporting, and again, all of these articles will be included in the show notes for today's show. So don't think that you won't have access to these. Feel free to go over to the show notes, click on the links, and check these out for yourself. This was from the 21st of September, and they released their second quarter 2017 home equity analysis, which shows U.S. home buyers with mortgages, roughly 63% of all homeowners, have seen their equity increase by a total of 10.6% year over year, representing a gain of $766 billion. Year over year, negative equity decreased 21.9% from 3.6 million homes. Over the last 12 months, approximately 750,000 borrowers achieved positive equity. But when you do all those numbers, you discover that still leaves us with an awful lot of homes, 2.8 million, that are still in negative equity. I can't help wondering, if we see the recovery, and I hate even calling it a recovery, if we see the trend of increasing home prices stop, what does that do for the 2.8 million homes that are still in negative equity? These folks have written this out. So they definitely haven't shown that they're the kind of folks who are going to jump ship. But I think it's an interesting number to have out there. And I think it's amazing that given how much increase we've seen, remember, we talked about 10.6% increase over the year. We still have homes that are in negative equity. In the vast majority of markets, that's not the case. In my marketplace, homes are worth more now than they were at the peak. So we surpassed that, about 6 months ago. So it's definitely a regional thing. You're going to have to look at your local areas. But what I find interesting is this sort of data is what really reflects how there are still amazing places out there to get potentially really good deals going. And I encourage you to use the techniques we've talked about here and some of the information that we share here on a regular basis to make that your starting off point to check some of these out and see if you can't find yourself a great deal in your area. All right, folks. I truly appreciate you taking the time to listen to what I have to say on these subjects. We've got a slightly shorter than usual show today. I hope it was just the right just the right size for you, filled in the time perfectly. And as always, the goal here is to leave you with far more value on the table than you invested in terms of time. Thanks again for listening, everybody. I'll talk to y'all next time.